strong rally to start the week on hopes President Trump is softening his stance now on tariffs. He said at an afternoon event that tariffs on automobiles and semiconductors would be coming soon, but also suggested that many countries could be getting breaks. And the major averages closed near the highs of the day after those comments. Joining us now to help us think through all this is Sam Stovall, CFRA Research Chief Investment Strategist. Sam, great to see you as always. In your note this morning, Sam, you wrote, "We continue to see an upward trajectory to this market, though with a lowered angle of ascent." Walk us through what that means, Sam.
Well, Josh, good to talk to you again. Essentially, a lowered angle of ascent, we come up with a 12-month target because for the S&P 500, that then helps the analysts when they make their buy, hold, and sell recommendations on individual stocks. Our target was 65.85 at the beginning of the year. It is still 65.85, which implies that now we're looking at something closer to about 6,400 on the S&P 500. So still a positive gain, but likely to be in the upper single digits, mainly because we find this likely to be a pretty challenging year, even though we're enjoying a nice counter-trend rally this week.
We are, Sam. Hey, it's Julie here. It's great to see you. So what needs to happen then to, make this more than just a counter-trend rally, right? To see those gains sort of take hold by the end of the year?
Right. Hey, Julie. Well, first off, I think you could say that this is a manufactured correction because basically it started with all of the tariff talks and then the worried from a cascading effect of slowing economic environment combined with sticky inflation, and then a series of downward revisions to 2025 earnings estimates. All 4 quarters are now expected to show year-on-year gains that are below what the estimates were on December 31st of 2024. So I think should we find a fairly rapid conclusion to this trade war, if you will, then I think that could help boost share prices as the year progresses.
I'm curious, Sam, when you try to pencil in your expectations for corporate profit growth in 2025, how much confidence you have in that, Sam, right now? Because it seems just tough, given the range of uncertainty we're talking about here, from tariffs to taxes to regulations and on and on.
Oh, absolutely. It's very tough. And so these are, in a sense, best guesses, if you will, because right now Q1 is expected to show about a 7% gain in earnings. But at the end of December, it was expected to be up more than 11.5%. For the full year, now the estimate is a little more than 9% versus the near 13% rise initially anticipated. So all of these numbers are quite fluid, and I think we have to wait and see what happens on April 2nd, 3rd, 4th, et cetera.
So in the meantime, Sam, what should investors be doing here? I know that you were looking at some of the highly rated CFRA stocks as places maybe to go while people are, maybe can put aside what's going on a little bit. CME is one of them, and I guess, with a lot of volatility in the market, that can be good for places that, trade for a living effectively.
Sure. Well, what I was doing was looking at those groups that have performed well since the March 13th bottom, because I looked at the speed with which the market declined a little more than 10% to fall into correction territory. And looking at all declines of 10% or more going back to World War II, I found that if it was a fairly swift decline, it typically ended up being a very shallow decline that then was followed up by a fairly swift recovery to break even and beyond. So I was looking at those groups that had been beaten up, but also where we have favorable technical and fundamental forecasts. CME Group was one of those. Mainly, we like the fact that both open interest and client acquisitions have not been appreciated, in our opinion, by the investing community. And the company trades at a discount to its historic averages as well as its peers. So the financial stocks we think should do fairly well.
Are there sectors, Sam, you would avoid here?
Well, interestingly enough, Josh, what typically happens after a correction is that the worst performing sectors are the ones that tend to take the lead. Consumer discretionary was down 16% during this correction, technology down 14%. Not surprisingly, they are the best performers on the way out. Conversely, those safe havens, consumer discretionary, healthcare, utilities, are the ones that investors rotate from in order to go into those groups that had been beaten up. So we're still indicating that we think that if we get a rotation back into growth, they're going to be leaving the defensives behind.
Sam, great to see you. Thanks so much for joining us.
My pleasure. Good to talk to you again.
Take care.